mortgage rates are the interest rates that lenders charge borrowers for home loans. These rates can vary depending on a variety of factors, including the borrower's credit score, the size of the down payment, the length of the loan term, and the current state of the economy. In general, mortgage rates tend to rise and fall in response to changes in the overall economy, with higher rates typically reflecting stronger economic conditions and lower rates indicating weaker economic conditions. It's important for borrowers to shop around and compare mortgage rates from different lenders to find the best deal for their specific needs. Mortgage rates are the interest rates charged by lenders when they lend money to borrowers to purchase or refinance a home. These rates can vary depending on a number of factors, including the current state of the economy, the lender's risk assessment of the borrower, the loan amount, the loan term, and the borrower's credit score. When the economy is strong, mortgage rates tend to be higher as lenders see a higher demand for home loans and the cost of borrowing money increases. Conversely, when the economy is weak, mortgage rates tend to be lower as lenders try to entice borrowers to take out loans in order to stimulate the housing market. The loan amount and term also play a role in determining mortgage rates. Larger loans and longer terms typically come with higher interest rates, as lenders see these loans as higher risk. Similarly, borrowers with lower credit scores may be considered higher risk and may be offered higher rates as a result. It's important for borrowers to compare mortgage rates from different lenders in order to find the best deal for their individual needs. Factors such as the interest rate, closing costs, and other fees can all impact the overall cost of a mortgage, so it's important to carefully consider all of these factors when choosing a lender. Benefits of mortgage. The primary benefit of a mortgage is that it allows individuals to purchase a home without having to pay the entire purchase price up front. Instead, borrowers can obtain a loan from a lender and pay back the loan over time, typically over a period of 15 to 30 years. Other benefits of a mortgage include building equity. As borrowers make payments on their mortgage, they build equity in their home. This can be a valuable asset, as homeowners can borrow against their equity in the future or sell their home for a profit. Tax benefits. In many cases, homeowners can deduct the interest paid on their mortgage from their taxable income. This can result in significant tax savings over the life of the loan. Stable housing costs. With a fixed-rate mortgage, borrowers can have a predictable monthly payment that will remain the same over the life of the loan. This can make budgeting and financial planning easier. Improved credit. Making regular mortgage payments can help improve a borrower's credit score, as long as payments are made on time and in full. Overall, a mortgage can provide individuals with the opportunity to own a home, build equity, and enjoy the benefits of stable housing costs and potential tax savings. Advantages and disadvantages. Advantages of a mortgage. Home ownership. A mortgage allows individuals to purchase a home without having to pay the full purchase price up front, which makes home ownership more accessible. Building equity. As borrowers make payments on their mortgage, they build equity in their home, which can be a valuable asset that can be used for future borrowing or selling the property for a profit. Tax benefits. Homeowners can deduct the interest paid on their mortgage from their taxable income, which can result in significant tax savings over the life of the loan. Stable housing costs. With a fixed-rate mortgage, borrowers can have a predictable monthly payment that remains the same over the life of the loan, making budgeting and financial planning easier. Disadvantages of a mortgage. High debt load. A mortgage is a large financial commitment, and borrowers can end up with a high debt load that can limit their financial flexibility and ability to pursue other goals. Interest payments. Over the life of the loan, borrowers will pay a significant amount in interest, which can add up to more than the original loan amount. Risk of default. If borrowers are unable to make their mortgage payments, they risk defaulting on their loan, which can lead to foreclosure and the loss of their home. Other costs. In addition to the principal and interest payments, borrowers may also have to pay for other costs associated with owning a home, such as property taxes, insurance, and maintenance and repairs. Overall, a mortgage can provide many advantages such as home ownership, building equity, tax benefits, and stable housing costs, but it also has some disadvantages such as a high debt load, interest payments, risk of default, and other costs associated with owning a home. How mortgage? Mortgages are typically obtained from banks or other lending institutions. To apply for a mortgage, borrowers must provide detailed financial information, such as income, expenses, credit score, and employment history. Once a borrower has been approved for a mortgage, they will receive a loan agreement outlining the terms of the loan, including the interest rate, loan amount, and repayment period. The borrower will then sign the loan agreement and provide any necessary documentation, such as proof of insurance or a property appraisal. The lender will then provide the funds to the borrower, who will use them to purchase the property. The borrower will be responsible for making regular payments on the loan, typically on a monthly basis. These payments will include both principal and interest, as well as any other costs associated with owning the property, such as property taxes and insurance. If the borrower is unable to make their mortgage payments, they risk defaulting on the loan, which can lead to foreclosure and the loss of their home. To avoid default, borrowers should carefully consider their financial situation before taking out a mortgage and make sure that they can afford the monthly payments over the life of the loan.